The markets are currently dormant for the holiday weekend, and Plug Power Inc., ticker symbol PLUG, sits frozen at 2.01 USD. During the last active trading session on November 28th, the stock managed to claw back 0.03 USD, registering a daily gain of 1.52%. In the after-hours electronic session, we saw a fractional drift upward to 2.02 USD. If you are a retail trader glancing at your Robinhood app or checking your SoFi Invest dashboard, you might see this green percentage and think, finally, the bottom is in. You might be thinking that with the recent buzz around hydrogen powering AI data centers, this $2 stock is a lottery ticket waiting to be cashed. The expectation right now is that Plug Power is a beaten-down giant, a sleeping dragon of the green energy revolution that is simply misunderstood by the market. The belief is that the pivot to AI energy solutions and the promise of the hydrogen economy will inevitably pull this stock back to double digits. The reality, however, is that Plug Power is currently performing open-heart surgery on its own balance sheet, while the hospital, the political and regulatory environment, is potentially catching fire. We are not looking at a standard growth stock dip. We are looking at a company that has explicitly paused its pursuit of a massive $1.66 billion Department of Energy loan guarantee because it fears the incoming administration might kill it entirely. The gap between the green hydrogen dream and the cash preservation reality is a canyon that investors are currently trying to jump across. To understand why 2.01 USD is not just a cheap price, but a critical danger zone, we have to look at the brutal mechanics of what has happened in November 2025. Let's start with the AI narrative because this is the bait. Plug Power has recently started aggressively marketing its potential role in the AI data center boom. The pitch is seductive. AI chips like NVIDIA stock GPUs are power-hungry beasts. The grid is full. Hydrogen fuel cells can provide on-site, clean, reliable power. Investors love this story. It ties a struggling industrial stock to the hottest sector on the planet. And to their credit, Plug has signed non-binding letters of intent to sell electricity rights to data center developers. This sounds fantastic, but look closer. They are selling electricity rights. They are essentially liquidating assets to raise cash. This isn't just about selling fuel cells, it's about monetizing whatever they can to keep the lights on. This is a survival tactic masked as a strategic pivot. The most terrifying piece of information for any shareholder right now is not the earnings per share, which actually beat expectations slightly in Q3, but the proxy statement filed for the upcoming January 15, 2026 special meeting. If you use Fidelity Trading Platform or Interactive Brokers to read your shareholder mail, you know what I'm talking about. Plug Power is asking shareholders to approve an increase in the number of authorized shares from 1.5 billion to 3.0 billion. Read that again. They want to double the potential share count. Why? Because they are effectively out of shares to sell. The filing states they have less than 0.4% of their authorized shares available for issuance. This is the reality that smashes the expectation. A company that needs to double its authorized share count is a company that plans to dilute you. They need that equity runway to pay off debt, to fund operations, and to survive until the hydrogen economy actually matures. If you are holding PLUG stock in your individual brokerage account, you are facing a potential flood of new supply. When supply doubles and demand stays flat, price crashes. This 3.0 billion share authorization is the sword of Damocles hanging over the 2.01 USD price level. Let's talk about the Department of Energy loan. For the last year, the bull case for Plug Power rested on this $1.66 billion government lifeline. It was supposed to fund the construction of new hydrogen plants in Texas and New York. But earlier this month, Plug Power announced it was suspending activities related to this loan. This is a polite way of saying they are retreating before they get rejected. With the political winds shifting in Washington, the company likely realized that a massive green energy loan was going to be a target for the new administration. By pausing it, they save face and perhaps try to negotiate later, but the immediate effect is that the free money spigot is turned off. They have to fund their growth themselves. And how will you fund growth when you're burning cash? you sell stock. Hence the need for 3 billion shares. I want to pause here and ask you, do you think the hydrogen economy can survive without government subsidies? Comment below with yes if you think the tech is ready, or no if you think it dies without the DOE. Now let's look at the financials from the third quarter of 2025. Revenue came in at $177 million, which missed the mark. The expectation was higher. However, the company did reduce their cash burn. This is the one spotlight. Management is furiously cutting costs. They are shutting down less profitable ventures, delaying capital expenditures, and focusing on cash preservation. This is why the stock hasn't collapsed to zero yet. The market respects the effort to stop the bleeding, but bleeding less is not the same as healing. They're still losing money on every unit of hydrogen they produce and sell, although margins are improving as they bring their own plants online. Speaking of plants, the Georgia facility is a technical marvel. It is producing liquid hydrogen at record rates. This proves the technology works. The engineering is real. If you visit the plant, you see the future of energy. But the economics are still brutal. Liquid hydrogen is difficult to store and transport. The green premium is high. Without a carbon tax or a subsidy, it is hard to compete with natural gas. This is the fundamental friction. Plug Power is selling a Mercedes-Benz product in a market that wants a Honda Civic price. For those of you trading on WebBull or using Fidelity mobile app to track technicals, the $2 level is psychological concrete. We have bounced off this level multiple times in late November. It is acting as a line in the sand. If the stock breaks below $1.90, the algorithmic selling could be severe, pushing it down to test the 52-week lows near $1.60 or even lower. Conversely, the resistance is thick at $2.50. There are thousands of bag holders, investors who bought higher, waiting to sell at break even. This creates a ceiling. We also need to discuss the short squeeze potential. Plug Power has always been a favorite target for short sellers. The short interest is high. If the company were to announce a definitive, binding deal with a major hyperscaler like Amazon, who is already a partner, or Microsoft, committing to buy gigawatts of power, the stock could rip higher. The shorts would be trapped. This is the lottery ticket aspect I mentioned. You are paying $2.01 for the optionality of a massive news event, but you are paying for it with the risk of massive dilution. Let's look at the institutional landscape. Recently, we saw Legal & General Group increase their stake by nearly 60%. This is a vote of confidence from a major institutional player. It suggests that some smart money sees value at these distressed levels. However, we also saw insiders selling. When executives sell shares at $2 or $3, it doesn't scream confidence, it screams, "I need cash." You have to weigh these two signals. The institutions are buying the long-term infrastructure play. The insiders are managing their personal liquidity. If you are using investing sites to research Plug, you will see a lot of sell ratings and hold ratings. Very few analysts are screaming buy right now. The uncertainty regarding the share authorization vote in January is a massive wet blanket on the stock. Why would you buy now at $2.01 when you might be able to buy at $1.50 after the dilution is announced? This is the game theory playing out. The Silex deal we talked about with other stocks isn't here, but Plug has its own complex financing. They recently raised about $400 million via convertible notes to pay off high-interest debt. This was a smart move financially. It lowered their interest payments and removed a restrictive lien, but it came at the cost of potential future dilution, since the notes are convertible into stock. It's another example of kicking the can down the road. They bought time to see if the hydrogen market matures, time to see if the data center pivot works. Let's go back to the data center thesis. This is the only new growth engine they have. The traditional material handling business, forklifts for Walmart or Amazon, is steady but slow growing. The electrolyzer business is lumpy and dependent on big project financing, which is currently frozen globally due to interest rates. The data center play is the wild card. If they can convince the world that hydrogen fuel cells are the best backup power for AI, the TAM, or total addressable market, explodes. But they are competing with diesel generators, cheap, dirty, reliable, and batteries, clean, expensive, short duration. Hydrogen sits in the middle. It's cleaner than diesel and lasts longer than batteries. It should win. But should doesn't pay the bills. Adoption does. If you are a self-investing trader, you need to treat Plug not as an investment, but as a derivative of the political climate and interest rates. If the Fed cuts rates aggressively in 2026, Plug flies. Cheap money funds green projects. If rates stay high, Plug suffers. If the new administration kills the green tax credits, 45V, Plug crashes. If the tax credits survive, Plug rallies. You are betting on macro factors more than micro factors. The 1.52% gain today is noise. It is just market makers balancing their books before the holiday. The real move happens in January. The January 15th meeting is the binary event. If shareholders vote no on the share increase, the company